Hi everyone. Some lovely, well-known faces in there. Right, we're meeting people through. Feel free to have your cameras on, off, whatever you do so fancy. Um, Welcome. Thanks for joining us today, everybody. It's going to be a very good session. Hi. Just give me my pets, but just as well I'm not staying on this call, otherwise I'd just be interrupting here and be like, oh, let's just have a little catch up with everyone. Thank you everyone for joining us today. As I say, have your cameras on, off, whatever you do, so choose. You've got a brilliant session ahead today. The wonderful Huw Sparkes from Midven Future Planet Capital is going to take you through investment readiness. So ask away, get your questions ready. I will be here in the background, so if you guys need anything, if anything goes wrong, just head on into the chat. But Huw, you're pretty much ready to go. So over to you, and I'll just keep meeting people as they come through.
Absolutely. Thank you very much for having me today. Very much looking forward to speaking to anyone I haven't spoken to before. I'm Huw. I'm one of the investment managers at Future Planet Capital Regional. We used to be known as Midven, which is probably the name that you would recognise from all of the marketing we've done over the last 30 years that we've been investing into Midlands-based startups. Our track record is of managing both public and private funds and investing into early stage companies based within the West Midlands region. Most of them have been technology companies, but there have been plenty of other different industries that we have supported over the years, all the way from medical devices and life sciences to consumer products and brands. And through that, we've supported some fairly chunky exits as well, including selling our companies to the likes of Samsung, Apple, many other listed companies. And some names you might recognize, Whisk, that now known as Samsung Food. If you have one of their smart fridges, that's run by one of our companies. Our team in the Midlands is 8 of us at the moment, soon to be 9, as we've got a new starter joining in a few weeks. All from very different backgrounds as well. My background is fairly linear. I have always been in venture capital. Started off with a venture studio in the Jewellery Quarter, and then joined the Midven team in 2019. You may have also met Rupert, who's one of the founding members of the Fortuna Fellowship alongside Tara and the fantastic team at the 50% Club. So there's a few of our portfolio companies that we have active at the moment. Just to give you a flavour of the types of companies that we've invested into over the last couple of years. Stroll is a company that is treating Parkinson's disease by using augmented reality technology to gamify movement therapy. It gives patients 7 times more care with 2/3 less physio time to make sure that patients are getting the right care in the right place. We led their seed round in 2023, and I need to update that slide because they've just closed a £10 million Series A to really push their expansion into the US. On the consumer products side of things, Ostique is a brilliant little company that's making the world's most silent ostomy bag that's completely leak-free and completely silent for people with stoma surgeries. It's also the only medical device to ever have been worn at London Fashion Week. And since we first invested back in 2023, they've won their place on the NHS drug tariff, and their app, which connects patients going through stoma surgeries with one another for support and care with one another. And finally, dentally, one of the stats that really stuck with me with this is at any given moment, 2/3 of people with false teeth have lost them. And to get a new set takes months of different fittings with different dentists and different people. It takes far too long. Dentally uses 3D scanning and 3D printing so that when you lose your dentures, you can get a new set exactly the same as your old one within a matter of days. And since we first invested in 2024, they have doubled their monthly revenue and opened 6 new clinics all over the country. The fund that we are currently investing from is very creatively called the West Midlands Co-Investment Fund. It's a fund that is backed by the West Midlands Combined Authority and a local pension fund to invest up to £1 million into early stage companies based within the WMCA region, which spans Wolverhampton down to Coventry. The only other threshold criteria that we have for this fund is that the company we invest into has to have at least 100k of revenue. We can then write a check between 250,000 and £1 million into those companies, with the slight quirk being we can only ever be up to half of the funding that is raised. And so in every company that we invest into, we try to match our expertise as an early stage investor with plenty of experience at seed, but in a multitude of different industries, with investors, maybe individuals or other funds who understand their sector and have that deep sector expertise, but don't necessarily have as much time in the early stage as we do. And so with that in mind, what we're going to be running through today is how you write an investable business plan. There is plenty of advice out there for free about how to write a business plan. But what most of it fails to acknowledge is that writing something for an investor who's looking to buy shares in your company requires a few different things and a few specific things to be included to make you as attractive as possible to an investor like me, or like Midven, or like any other VC. And so that's what we're going to be going through today. Feel free to chime in with any questions. I can't see hands up for some reason on this view, so please do chime in with any questions that you have as we go through. So the first part of approaching any investor is understanding the type of investor that you're speaking to. One of the biggest mistakes that every company will make at some point is investing loads of their own time talking to investors who are just not the right fit for them, but whether that's because of the stage they're at, the check sizes they're writing, or actually the type of investment that they make. First thing to understand is where you sit within this ladder. So along the bottom, you have how big a company is, generally revenue, and along the side, sorry, you have how easy it is to raise money into your company. And as you can see, as many of the companies that you guys run will have come across, there is a little gap at the bottom where when you first start up, it is really, really hard to raise money into your company. Often you are reliant on grants, and if you're not familiar with grants, most of them are public sources, government money, with no expectation of giving it back. It's just money given to your company with a specific goal in mind. Normally that's some kind of proof point or technology, or it can be literally anything. Grants start from as little as about 5K and can go all the way into the millions with various different authorities that are running them, various different expectations that they'll have on the company. But if you want to get some actual money into the company that's not just for a project, you start getting external investors, private investors, and often you'll start with one or more of the three Fs, which, if you're not familiar with the term, friends, family, and fools. There's three groups of people likely to invest into your early stage venture. The friends and family that you have because they back you and they're willing to invest their personal cash into you, and the people who don't really know what they're doing, and they're not going to be particularly value additive to your business over time. But unless you've come from a very specific background, you probably don't have friends and family who are willing and able to write very large checks into your company. And that's when you start going out of your network into angel investors. Angels are one of the most important parts of the entrepreneurial ecosystem in any country, but particularly in the UK, where you have things like EIS and SEIS to encourage more angel investors to invest. Angels are normally exited entrepreneurs themselves. They've built a company, run it, sold it, got some money from it, and then can invest not just cash into your venture, but also their time and their expertise to work with you, maybe as a non-executive or just on an advisory board that you're building. Angels, we are massive fans of working alongside angels. In fact, pretty much every business that we've invested into from the co-investment fund has had at least one or two angels who've then taken a non-executive position on that company. And you can be quite creative about the types of companies the type of people that you approach. A consumer products company that we did about 2 years ago now, in the cosmetics space, we asked the founder the question, if you could pick anybody in the world to be on your cap table, who would it be? And she gave us three names, and we managed to get in touch with two of them, and one of them is now the chairman of that business. So it does work, getting in touch with those people. But angels are investing their own money, which means they don't have unlimited pools of it to give to other companies. And so that's when the venture capitalists come in. That's where we are. VCs manage big pots of other people's money on their behalf, investing into companies with a different strategy, with different strategies, different stages. It goes all the way from pre-seed, just before where we are, where maybe you're in the very early stages of commercialization, and then you have other funds that are writing Series A, Series B, Series C, it goes on. The highest I saw was H over the last couple of years. Each time VC money is used to accelerate your growth. You will already have some traction by the time you go to a VC, and their investment is used to pre-fund things like sales and marketing, technology development, market entry, going into different territories, different countries, things like that. At every stage, it's being used to accelerate your growth beyond what you currently have the capability to do. Above VC, we have the private equity markets, where rather than being used for organic growth, the money is used for inorganic, so acquisitions, consolidations, restructurings. And then above the private markets, you have the public markets, where retail investors like your neighbor can invest into any company. And as you grow the size of your company, once you're on the main stock market, it's very, very easy to raise additional funds into your company. At every stage, there's equity investment, but there's also debt investment. I'm not going to talk you through any debt investment because that's not my bag at all. But as you can see, lots of different options that you have available to your company. And so it's worth understanding where in this ladder you currently are. And so where we sit, if you look on our website, you will see that we look for businesses that share these traits. You have to be based within the West Midlands Combined Authority region. You have to have at least 100K of revenue for us to be an eligible investor. And we look for companies that have been trading for less than 7 years for a couple of tax reasons that I won't go into. In the last year, we've reviewed about 800 business plans. I'd probably say 500 of them met that threshold criteria, and we made from those 7 investments. So it's quite a steep cutoff rate between pitch decks that we see and investments that we make. And so what are the key traits that we actually see that we back properly? Well, firstly, we look for exceptional leadership. We're normally invested into a company for between 5 and 7 years. And that means that we need to trust that the founder is going on a journey with us. And that means being open to learning new things, accepting advice from other people, being willing to surround themselves with people who have been there, done that, and can be useful and giving their knowledge over time. We look for founding teams generally rather than individual founders. And as part of that reason, we want to know that the founding team balance each other. They have complementary skills with one another. Secondly, we look for companies that can say that they are the only company that does what they do in the way that they do it. And we very creatively call this the onlyness. But an onlyness only goes so far. Why are you the only one? And we could stand outside a cinema and be the only seller of dog food flavored popcorn. We would probably be the only one, but that doesn't mean we'd be popular or investable because we're not solving a market need that people have. And that's where the equity story comes in. With an equity investment, it differs to a debt investment because we only make any money when we sell our shares for more than we bought them for, which only happens when you grow quickly and have a whole load of people interested in what you do and taking you out of the market. And so we look for a company that can tell us the story of where they're going and why they're going there. An equity story needs to be easy to follow and capture the hearts and minds of potential stakeholders and investors with a very clear North Star end goal in mind. And one way of trying to visualize this is to imagine that your business is a jigsaw puzzle that you have designed. You know exactly what the picture should look like because it's your business. But when you pitch that business to somebody who doesn't understand the journey you've been on to date and doesn't know from inside your head where you're trying to get to, we don't know what the picture looks like. So our first job as an investor is to find those straight edges, put them together. Then we start looking for color blocks in the middle and work our way inwards. And so if your pitch deck is unstructured or cluttered or doesn't have a clear goal in mind that you're trying to get to with your funding, you're doing the business equivalent of throwing 3,000 pieces on the table at once and expecting us to know which parts go with which. So your pitch deck needs to tell a story, and your story needs to be easy to follow with a single goal in mind. You can expand into other markets later, but as an early stage business, you need to be very clear about where you're trying to get to. And as an example, when Jeff Bezos walked into a venture capitalist office back in the early 90s, his vision was to set out creating the everything store, one place for everything. But he didn't start with everything. He started with books because they fit in the existing mail package infrastructure. Didn't require changing anyone's buying habits because how much time do you really spend buying a book? But the goal was always there to expand from books into DVDs, into CDs, into larger and larger, more niche items over time. with the goal of creating the everything store. And so when you're going in for your first round of venture capital funding, you're going in for books with a view that over time you expand into different markets, different territories, different geographies, and create your North Star metrics and your North Star over time. So, how do you go about creating a compelling investment proposition? The part of the equity story is this, the part of the equity story that's demonstrating that you really solve a market need that people are going to be excited about over time. And there's four main things that we look for in every proposition that we see, and every investment that we made will have been in this center of this diagram here. So, firstly, we look for companies which have a product solving a real market problem. We look for a market which is big and growing. We look for a team that can execute and deliver on the plan that they're selling us. And all these things need to be happening at the right time, with the product in the right state, the market's ready for the innovation, and the team with the appropriate experience for what they are doing. I'm going to dive into these a little bit more now. So this is shamelessly stolen from Y Combinator, who have a very good online YouTube series about demonstrating your value proposition, which if you haven't seen, would thoroughly recommend that you look at. But this goes through the problems which venture capitalists absolutely love to see. So firstly, we love to see problems which are popular. Do you have millions of potential users all around the world? And is that number of users growing over time? Is it growing at 15 or 20% a year? Because that's then a market which is accelerating rather than declining. Is it a problem which is urgent, which needs to be solved now, which people feel a real pressure to solve? Or is it just really expensive to solve with existing solutions? Does it cost billions of dollars a year to solve with the existing solutions in the marketplace? Better still, is there a regulation change that's coming into the market which means it's mandatory for this problem to be solved? For example, if you're in the medical sphere, is there a new regulation coming in or a new law coming in that says the way of doing things at the moment is just not satisfactory anymore? And finally, do your millions of users all around the world face the problem that you solve multiple times every single day? And this is why when you hear any VC talk about how you structure a pitch deck, they'll say start with the problem, then go to the solution, because you need to be able to demonstrate that you have at least some of these problems identified, and the product that you've developed solves at least a few of these problems. You don't have to solve all of them. In fact, very few companies can honestly say that they solve all of these different areas. But if you don't solve any of them, you may well be the dreaded SISP, the solution in search of a problem. This is surprisingly common. A lot of companies come to us having demonstrated that they've developed the greatest solution in the world to a problem that nobody has. And then it becomes really tricky for you to gain any kind of market access because people don't really have a motivation to buy from you. Does anyone remember blockchain? That was the big issue that we had a few years ago. What problem does blockchain really solve for us? And yes, more are now developing over time. But when we ask the founders, what's the problem with the existing ways of doing things? That's where you need to start with your problem, then go about your solution. So we've covered the product. The next part was the market, and there's a few areas that we need to go through in the market. First of which is competition. And competition is not a bad thing. Competition means that there is a big enough market to go after because multiple companies are trying to go out of it. But what we often see in a pitch deck is some variation on this, with a couple of cherry-picked features that you have and your competition doesn't. The problem with expressing your company like this is that the buyer's motivation is different depending on whether they're in the market for a Rolex or for a frog watch. The fact that they both tell time the frog watch is affordable and the frog watch is a frog isn't necessarily a compelling competitive advantage over the Rolex when the buyer's motivations differ for each. So a much better way of expressing your competition is something like this. And this is how we actually look at things internally as well when we're writing up our investment proposals. And this is with thanks to a VC in London called Paddy Stobbs, whose name has been covered by my logo at the bottom there. Firstly, top left, you identify which problems your solution solves and which of those problems are not solved by existing players in the marketplace. You go a step beyond that to say why that actually matters to your customers. Is it because they are, if it's the problem is cost, are budgets being cut in that industry? If the problem is frequency, are you just more accessible because you've got a better routes to market, a better app for customers to show? And then you go a step further again at the bottom and describe your moat, which is how do you defend your market position from other people? Your company is no longer a jigsaw puzzle. It's now a castle on a hill with a deep, wide moat all the way around it. And the deeper and wider that moat is, the harder it is for other companies to come in and steal your market from you. So what's your long-term defensibility against other people coming into the market, solving the problem in a different way and stealing market share from you? Sometimes it's IP, sometimes it's brand, sometimes it's just how well known your team is in the market. But either way, let us know. Tell us what your moat is, because then we'll find that you are more investable as an entity. Second part of market is how big is the market? And there's two main ways that you can express how big your market is: top down and bottom up. So the one that we often see is top down, which is X consulting firm has said that this market is worth $200 billion a year. And all we need to do is get 1% or something along those lines. It's not very compelling for us as investors when we see those words on a pitch deck, because it just raises more questions. Well, firstly, how are you going to get your 1%? But which bit of that market are you actually going after? If you just tell us that the market as a whole is worth this, that might not be the bit that you're actually doing. If you're in the cybersecurity space, if you tell me the entire expenditure on cybersecurity, well, what about the expenditure on bits that you do? And so the much better way that we will do anyway when we're going through our due diligence, but if you can do it in your pitch deck, it shows a certain amount of maturity as a business, is to firstly start by identifying how many potential customers you have in a certain segment, possibly in your initial markets or your initial country, or your initial industry. Secondly, how much is an average customer worth to you in a given year? By multiplying the two together, you then have your segment size. This is how big this market is if everybody who could be a user of our product at our price was a user. And then you move into, okay, what's the next market for us? Maybe that's a different country or a different subset of customers. Multiply that by the cost for that subset, and you have your second segment. And you build that up over time to build up your total addressable market, or your TAM, based on a bottom-up approach. And taking Stroll as an example, the company we looked at earlier, their initial market focus is Parkinson's disease, and there are 800,000 people with Parkinson's disease in the UK and 9.6 million people worldwide. At their average cost per user, that's how we got the initial market size for both the UK and the next territories being the US, Australia. But then we can move into different diseases like MS or traumatic brain injury. And how many people have that? And we built up this picture of how many different segments are there based on moving from market one to market two to market three over time. This is how big the total addressable market is for our product. And as a rule of thumb, we try to invest into companies where the initial segment size is worth at least £100 million per year, and the total market is worth at least £300 million per year. Every investor will have their own variation on that, but that's where we tend to sit. Reason being, you then don't need to have massive market penetration to be a good sized business for us to have invested into. So try and think about that from that perspective, because it shows a few things. Firstly, that you've been to something like this and you've learned from people on the ground floor how to do this kind of thing, but also that your business is of a certain maturity, that you know who your customers are and how much they are worth to you in a given year. And that makes you sound and feel much more investable as a business to the investor on the other side of the table. So we've had products, we've had market. Finally, we're on team. And particularly at the early stages, when we're talking seed and pre-seed investments, the team is one of the most important factors that we look for. Reason being, there's not often that much business for us to actually do our DD on. And so we rely on backing people because the business can always change. It can pivot, it can change direction. The people are more permanent when we go through this process. And so there's a few factors that we look for. Firstly, what's your unique insight into your marketplace and your solution? Perhaps you have been a customer of this and you've seen how badly it's done by your competitors because you were one of the customers. Um, and then we want to understand, what does each team member bring and to make you greater than some of your parts over time? Is everyone incentivized in the right way? Do you have a share option plan for the people who are not ordinary shareholders? And are you all going in the same direction? Is your North Star aligned? And then how adaptable and resilient are you? Because being an entrepreneur is really hard, and you will be hit in the face multiple times by things as you go through your journey. And it's how you recover from that that really matters to us. So when it comes to what does each member bring, the reason for the rugby photo, I'm a Welshman, so rugby is the only thing that I used to be any good at. Every member of the team has their own role, and everyone is built in a different way to do a different job when they're on the pit. And so what we want to understand is that everyone knows what their role is and what the long-term goal of the entire team is and how they each fit in to that goal. And when it comes to building up your founding team, that's a really tricky bit as well, and something to really think about. What are your strengths and weaknesses as a founder? Or what are the bits that you enjoy doing as a founder versus what you want to hire somebody else to do for you over time? So we've got a product that solves a problem. We've got a market that is big, growing, ready for us to innovate. And we've got a team that is incentivized, built the right way, and ready to execute on that plan. How do you execute on that plan is going to be another question that we ask. And for anyone who hasn't seen the film Moneyball, which I didn't until quite recently, because someone told me it was about maths, and then somebody told me it was about baseball, and neither of those things made me particularly want to watch it. When I eventually did, my reaction to it was it's a film about strategy. So, for those who don't know the story, Brad Pitt on the left-hand side there, whose character's name I do apologize, I've completely forgotten, is the manager of a struggling baseball team with a very low budget. And one year he loses his two best players, and his scouts are still trying to do the old-fashioned way of picking teams based on just strength, height, how confident they are, things like that. He decides he's got nothing to lose, and so he tries a radical new way of picking his players with a maths and stats-based strategy invented by Jonah Hill on the right there, which is called Moneyball, which is a way of selecting your players not just based on how good they look in their different positions, how well they have performed in different positions with different play styles on the other side. And the upshot of this is within the first year of doing this new strategy, despite having a team that is far cheaper and far less heavy hitting than some of the oppositions, his struggling team wins the league just by putting in a brand new strategy. And then within 3 or 4 years of that, that way of picking players is the standard, and it is still to this day the standard way of picking players for the baseball teams. And so one thing that you can try and consider for your business is, what is your money ball? What's the way of picking, or what's your strategy that nobody has ever done before that means you can compete in an unfair game? Because that's what business is. If your way of acquiring customers is purely based on Meta and Google Ads, it's not going to be a very easy ride for you, because somebody with a bigger round with a bigger check book can just bid more for the same ads, and then you will continue to lose out to those customers, particularly when you're to those competitors. Sorry, because when you're a startup, nobody in the world has a smaller budget than you do. So what's your way of acquiring new customers that doesn't just rely on buying them over time? Because, and this is the line that stuck with me in there, if you try to play like your competitors, you will lose to your competitors over time. So how do you do things differently? So we have product, we have market, we have team, we have a strategy of going out to the marketplace. And I said we'd come back to timing as an important factor in this. And it's not just me that says that timing is an important factor. This is some research done by this chap, Bill Gross, who runs an accelerator in Silicon Valley called the Idea Lab, which he founded because he thought the most important factor in whether a startup would be successful is the idea that the founders had. But what he found after having hundreds of companies go through his accelerator and become household names over time, he found that actually the idea often moved and changed over time. And so the idea can't have been the most important factor. And so he did some research into those companies that had succeeded and those that hadn't. And he ranked each of these factors: funding, business model, the idea, the team, and the market timing for each of them, and which had those factors in abundance, which ones were struggling. And he found that the most important factor, the most common factor in companies that did really well was how the timing with which they went into the market. And to put this into context, Airbnb was one of the companies that he had worked with, which when it launched in 2006, 2007, the idea of renting out a spare room in your home to a complete stranger was alien. Nobody wanted to do that. And the idea of staying in someone's spare room was, who would want to do that for their holiday? But then 2008 financial crash happened, and suddenly renting out your spare room was a really easy way of getting some extra money into the house. And going to someone's spare room on holiday was a really cheap way of having some time off at a time when that was really important because nobody had any money. And so for them, the timing was one of the reasons that they were able to continue to scale and build up that market traction over time. And YouTube was not the first video sharing platform. It was not an original idea that the founders of YouTube had. And it actually launched without a way of making any money. It had no business model whatsoever for the first couple of years. But it was one of the first video sharing platforms launched once more than half of the houses in the US had the internet. And so it was able to capture market quicker than anybody else had done so and become the dominant player that it is in the market today. And so a question that you will be asked by every investor that you go and speak to is, why now is the right time for your business? Why not 5 years ago? And why not in 5 years? And so think about that from your perspective. Why is now the right time for me? We've been burnt by this as investors. We invested into a company that called meals.com, which was Deliveroo, way before Deliveroo was Deliveroo. And it floundered around for a few years and never really found its feet because not enough people had smartphones at that point, and not enough takeaways had the ability to accept online orders at all. It's still done over the phone. And so eventually the founders stopped, gave up, and then a few years later, Deliveroo launched, and look at them today. But that was one of the case studies that we have internally for why timing is a really important factor for us, and why now is a fundamental question that you will be asked by investors. So you've made it all the way through the first couple of pitch meetings with the investor. We're then looking at structuring a deal and how we can invest into your business and give you the tools that you need to succeed over the next few years. And something that's worth thinking about before you get to this point is just, firstly, understanding that the way that we make money as equity investors is by buying shares in your company and then holding them for a few years and selling them to somebody else. We don't charge interest. We don't charge any meaningful fee to you as a business. And so that's the only way we have of making any money as an investor. We need to think about the exit for our investment. And so no one's expecting you to have a crystal ball to tell your investors exactly how they will exit. But what we need to know is that you are working with us towards the exit point. And the most successful exits are there when the entire business is acquired by a larger player. So we saw the slide from earlier on. We've exited companies to very large companies with Samsung, Apple, Microsoft. Sometimes it's smaller companies. Sometimes it's companies you'll never have heard of. But one thing that we need to understand from you as a founding team is that that's your goal with this, that your business is not one that you want to run forever and hand over to your grandchildren in 50 years' time. Because if that's what you want to do, that's absolutely fine. But that means that venture capital is possibly not the right source of funding for you at this point. And you should think about where else you can go to get the money that you need to scale. And so something to think about is, why would somebody acquire my business rather than compete with my business? And that's probably linked to the moat that you were thinking about earlier as to why it's difficult for other people to replicate what you do, even if they are a multi-billion-pound listed company. So that in a nutshell, and I do apologize for how much splurge that has been, just information dump on you. Um, Something that we need to have something often asked about is how do we value a company? If we're buying a stake in this business, how do we how do we decide how much it's worth day one? Well, the first thing to think about and to understand is how a new share issue actually works, because one of the most common objections that people have to venture capital and equity investment as a whole is the founder doesn't want to sell their shares in their business. So if a investor offers you £500,000 for 20% of the business, it does not mean that you are losing 20% of your shares. Instead, the company has issued brand new shares on top of those that were already there. The investor then buys those shares from the company, and so the founders have the same shares that they always did. There's now just more shares in issue than there were before. And so to try and keep the maths as easy as I possibly can for a Friday afternoon, uh, that £500,000 for 20% means that after the investment, the business will be worth £2.5 million because there's 1.2. The investor has bought a quarter of a million shares for 20% of that business. If the business is worth £2.5 million post, and there were a million shares in issue before, that means there need to have been 250,000 shares issued in the business. But those million shares that were there before are unaffected. So the founders, before the investment happened, had a million shares. If the £2 per share is carried forward between the pre-money and the post-money, that means we have a £2 million pre-money valuation and a £2.5 million post-money valuation. And you'll hear investors use those terms a lot of the time. Your shares are still worth £2 million. And the idea is after this round, the next round is not at £2 a share, it's at £5 or £10 a share. And over time, as you raise round after round, if you raise round after round, you will own less of the business as it grows, but your million shares, you keep them. And over time, the share price goes up so that your million shares are worth more and more and more over time. Jeff Bezos now owns about 15% of Amazon because of the number of rounds that he has raised. Not sure he's complaining that that's not enough of an ownership stake to give him a meaningful net worth, but that's how this works over time. And eventually, you start getting into the realm of sometimes you want to sell part of your shareholding over time just to take some cash off the table because it can feel like a bit of a roll of the dice, raising round after round after round. But the important thing to remember is that the shares that you own are yours until you decide to sell them. And if you own less of the business, that doesn't mean you own less value in your business over time. And that £2 million pre-money valuation is not made up entirely. That's about where most investments end up being at the seed stage. And the average valuations are going up over time. This is a few years old, but 2021 was it stayed around the same level since then, maybe slightly over. But as you can see from the blue line, which is the first round valuation, it was just over £1 million pre-money for the first check that you raise. And then the second round, which is normally when you're coming to institutional investors like us, was about £2.5 million pre. So maybe twice the share price of the first investment. And so as a marker, that's the kind of things that you can be expecting from the investors that you're talking to. And the ways that there are obviously many ways that they can be higher or lower than that valuation. And much of it will come back to, do you have product, market, team, and timing? But there's a few other things like, do the users you have stay with you forever? And are you growing quickly at 10, 15, 20% a month in some cases? Do you have the IP as part of your moat? And are you in a market that is growing and fast and big and ready for you to innovate in it? It's worth noting here that if you don't have any of these things, it's possibly not a case that you raise money at a lower valuation. It's more a case you'll find it really hard to raise at all if you have a leaky bucket of customers who leave quite quickly, or you're growing very slowly, or not growing at all. It can become trickier and trickier to raise money at all if those are true. And so how do you maximize your chances with an investor as you go through this journey? Something that's often overlooked by founders is how long this process takes. So we are very used to being the first institution and the first big investor that companies have had, and we've therefore made our process as linear and as straightforward as we possibly can. You have the first meetings with your deal team. Once you've met a few of the senior investors, we give you a term sheet and go to our investment committee where you meet the entire partnership of the fund. If they approve it, you get your formal offer, and we go into due diligence and legals, and then we give you some money at the end of it. But even for us, being a dedicated seed investor that's used to doing deals quickly, this process is between 12 and 16 weeks. So 3 months at the very least from first meeting to cash in your account. And it's going to take you a bit of time to find the right investor as well. The first person you speak to won't necessarily be the one that you end up going with. And so when you raise your money, make sure you give yourself 18 months worth of cash from that investment, because that means you can spend 12 months executing on your business plan without needing to worry about where your next payroll is going to come from. And then you can spend 6 months raising your next round under no pressure because you're not running out of cash in the next few weeks. The number of companies we've seen that come to us with a matter of weeks of cash left in the bank is frankly scary. And so don't be that founder as you go through this process. I won't read these out to you. We'll send the slides out to you afterwards, but this is a kind of general overview of things to bear in mind as you are going through the process. But what it really all comes down to is this again. Do you have a product which you can demonstrate solves a real pain point for people in your market? Is that market growing, large, and ready for innovation? And is your team one which is well constructed, balanced, well incentivized, and knows which direction it's going in? And are all these things happening with the right timing for each of those elements? Because if you're in that center blob in the middle there, you have a much, much higher chance of being in the 1% of businesses that get venture capital funding at each stage. I hope that's been helpful. I hope that's been useful and interesting to you. That's my LinkedIn. If any of you want to add me and have a follow-up of any kind, feel free. Or my email address is at the bottom there. We are, of course, heavily involved in the Fortuna Fellowship and the 51% Club, so I'm sure I'll see many of you around at various events over the next few months. Any questions? No questions.
Sorry, I have a question.
Yeah.
Do you have or do you provide like business plan templates for people venturing into this, or do you just get people to sort of come up with their own ideas in their own format?
Yeah, so it can often be much better to do it in your own style, because the pitch deck is your way of telling your story to us, and that story will always be different for every different business. As a good starting point, there's an article by an investor called Guy Kawasaki, which is the 10-slide template, which I think is really good as a starting point for your first draft. But over time, your deck will evolve to be specific to your business and tell the story that you need to tell for it to go through.
Thank you.
Question from Emmeline there. Any case studies or examples of ways businesses have demonstrated their Moneyball? Yeah, plenty. So I was quite impressed with a company that was doing, it's sadly no longer trading. So it's maybe not the best example in the world. But they had a marketplace for selling secondhand technology. So you could list your old phone for sale, and rather than it be a fixed price that a company would then have to buy and then sell, they'd set up effectively a stock market. So depending on how many people were listing iPhone 15s at the same time and how many people were trying to buy iPhone 15s at the same time, would determine the price that was given to them. And so you could try and play the market slightly, rather than spend loads of money on Google ads and Facebook ads. They started paying taxi drivers to have little covers over the headrest on the driver's side with a QR code to sign up. And so the taxi driver would receive a small fee from having that there. And they had a referral bonus as well. Each QR code was unique and linked to that driver to make sure it stayed there. But as a way of getting in front of hundreds or thousands of people very quickly in a way that other people wouldn't necessarily think to do, as a way of getting in front of those people uniquely. Plenty of ways of doing that. Actually, my favorite example is Innocent Drinks, who, when they were trying to raise their first big private equity round, knew the investor or knew which investor they wanted to get in front of. And they wanted to give the impression that they were a much bigger business than they were. So they found out which route this investor took to commute into London each morning, and they bought 2 billboards, one on his first station and one on his last station. And so the impression that they gave to the investor was, oh, this company is huge. They've got adverts everywhere. I'm seeing them all over the place. Whereas in fact, it was just the 2. So plenty of ways of being creative when you're trying to get in front of the right people. And that's what the money ball is. It's a way of getting customers involved and excited about what you're doing without needing to just throw money at adverts through that process. Any other questions? No. So if any come to mind afterwards, feel free to find me on LinkedIn or drop me an email, or I'm sure I'll be seeing many of you at the 51% Club events over the next few months and years. Wonderful.